Hey everybody, it's Nick. I want to jump on real quick and address the CPI data that just came out. So let's take a look at this. So right out the gate, we can see the headline, stock futures jump after CPI report on hope inflation is peaking. NASDAQ 100 future gains 1.6%. Who's been talking about this, right? Who's been saying that we might be getting close, that we're seeing what's happening around, people are starting to tighten. So I'm not saying that we've peaked, not saying we're getting there, but I'm saying it's getting close. All right, let's read this article. U.S. stock futures rose as the March consumer prices report showed inflation, excluding volatile food and energy costs, was slightly less than expected. A drop in rates helped boost stocks. All right, that's a good thing. Futures on the Dow Jones Industrial Average gained 216 points, whatever, all that stuff, right? We get that. Things are looking good. And for all of you Tesla investors, let's take a look at this. As of right now, Tesla's sitting at, looks like 28, let this refresh. Yeah, okay, $25. Looks like up about $25 right there. You can see it. All right, so up $25. That's a good thing, right? So that means that we're kind of taking a little bit of the fear out, right? We're up back over $1,000. That's excellent. All right, so consumer prices for March increased 1.2% month to month and 8.5% annually. The Labor Department said on Tuesday, but traders were focusing on the core reading, which excludes food and energy prices. Why? Because energy is just extremely volatile. Energy is something we can exclude now because we understand what's happening right now with Russia and Ukraine and how that's impacting everything else. We understand there's not enough oil out there. So, okay, that's something that's been baked in essentially. If food costs going up, again, something else has kind of been baked in. So what we're really looking at is what's real inflation excluding that, excluding those high levels that we already expect. Core CPI increased 0.3% below the consensus economist estimate from Dow Jones of 0.5%. That's almost half of what was expected. Core prices on an annual basis were up 6.5%. The 10-year Treasury yield retreated from a 3-year high following the reports as traders were betting the core reading could mean inflation is showing signs of peaking. All right, so this is excellent news, okay? This is all pointing towards signs that we might be getting to that top we wanted, right? I said in yesterday's video that I wouldn't be surprised if we saw a slightly better number than what we expected, it's a little bit below. Now, mind you, we came right at, so I was wrong about that, but my premise was still intact. My premise has been that I can see, right, the people around me, the spending, what I'm doing myself. I kid you not. The other day, I was at the grocery store. I was at Publix, and I went to buy ice cream. I had this craving for ice cream. I'm a big mint chocolate chip fan. Let me know down below what kind of ice cream you guys like. But I was going around, and every single thing was like $6.50, $7, $8 for a little tub of ice cream. Even the Publix brand ice cream was unreasonably priced. So I just walked away. I was like, I refuse to do this. I feel like I'm being robbed right here. Like this does not feel like a good exchange. And I chose not to get ice cream. Now, can I afford it? Yeah, I can. But the point is, if you feel like you're being taken advantage of, a lot of times, I'm not even going to enjoy that ice cream if I feel like I'm being taken advantage of. Now, that's one small, minute example, but that's what happens throughout the entire economy. People see things like, no, that's too expensive. Nope, not worth it. And they make second choices, or they decide, you know what? We won't spend money on that. We'll save. We'll wait a little longer, right? And that's what happens, and that's what can slow down inflation. Now, if we're taking food and we're taking energy out of the equation, well, then maybe, just maybe, we can get this inflation under control. All right, well, let's continue reading the rest of this article. I think, quote, I think by the summer, we'll probably see the CPI inflation rate peak, and then the consumption deflator is going to peak somewhere between 6 and 7%, and then come down to maybe 3 to 4% by the second half of the year going into next year. Okay, so that was from a researcher told CNBC, closing bell overtime on Monday. Okay, the recent spike in U.S. inflation has helped increase expectations for tighter monetary policies from the Federal Reserve. In other words, the Fed's going to increase rates. They're going to stop, buying so many of these yields, these treasury notes out there. They're going to stop, injecting the economy with money. All right, so the Fed raised rates at its March meeting, and it's expected to hike more throughout the year. Yeah, a lot more. The 10-year Treasury yield fell more than 6 basis points to 2.717 following the CPI reporter after earlier touching 2.82%, a level not seen in more than 3 years. Okay, this is wild. All right, so the rest of this, investors are also awaiting the start of earnings season to kick off Wednesday. I mean, we're all waiting for Tesla earnings. Okay, cool. So let's recap this. Okay, so CPI, it came at what we expected. That's a good thing because it came right where we expected, right? We didn't have this like crazy extra hot number that the Fed was essentially, pumping into the market, this fear, right? And that's what it felt like. Like, I get it. The Fed has a certain mandate that they have to, keep inflation under control. But this, constant back and forth, this flip-flopping by the Fed is just ridiculous. And don't tell me that they're not putting these Fed members out there intentionally trying to spook the markets. They are. There's no way they're not. It's not a coincidence, right? I think this is all intentional. It's a big game that they're playing, all right? And like, I get it. They have a mandate, and that's what they're trying to adhere to. But to me, it's morally not right, all right? And the best way to think about it is, from a moral perspective, it's like saying, and what the Fed's saying is like, okay, I have 2 million people here that are at risk, and I have 15 people over here. Am I willing to sacrifice the 15 for the 2 million? All right, well, yeah, in theory, on paper, you would say, yes, I am. But if I were to ask you, okay, what if those 15 people comprised of your friends and your family, your mother, your daughter, your sister, your brother, your grandfather, would you sacrifice those 15 for the 2 million? Well, that's where things become a lot harder, right? Now, for us, those 15 members or whatnot, that's our money, all right? That's our money. And the Fed is essentially just playing with it to try to get on paper, their number down to where they need it to be with regards to inflation. So it's this back and forth that, look, we know what's going to happen. We know what to expect. And that's why we're able to call this ahead of time. Now, I'm not saying that I can predict what's going to happen in the future, but we understand where the Fed is at. We understand what the Fed has to do. They don't have a choice. And so we can try to make some cognizant decisions ahead of this. Now, this is why I preach long-term investing, because if you are invested for 5, 10, 20 years, honestly, all of this is just smoke and mirrors. None of this really impacts you at all. Over the long term, things are going to go up and to the right, especially with Tesla. Well, maybe that'd be a little more S-like than up and to the right. It might just, be kind of, exponential straight up. Anyway, all right, that's what I hope for at least. But the point is that if you are a long-term investor, like these blips in movement don't matter. But from a investor perspective, a knowledge perspective, and awareness perspective, you should understand what's happening, right? At the end of the day, you should know where your money is at all times, all right? It's no different than if you were a manager and you have a whole bunch of employees under you that you're responsible for. You really want to know where your employees are, right? You want to know, even if they're working remote, are you at home? Are you working? Okay, cool. I just want to know where you're at. I want to know you're working today, that you're not on vacation or whatnot, right? Doesn't mean I have to micromanage. Doesn't mean I need to know, what they're working on at that moment. But I need to be in touch, right? I need to be able to touch base. Maybe have a one-on-one every week with them. Same thing with your money. You need to stay in touch with your money and what's going on with the markets, right? You don't want to be in a state of flux, in a state of, I don't know what's happening, right? And that's why we track these things. That's why we make this type of content so that you guys can be aware of it and understand what's going on, mainly from a Tesla perspective. Why? Because I'm all invested in Tesla other than my real estate. All right, so we're going to leave it there. Just want to jump on, talk about this. I think this is very good. It's the fear. The fear out there was more than it should have been. All right. It's, don't let these things be the reasons you go in and out of markets. Okay. Be aware of what's happening, but it doesn't mean you should be making moves or reacting to it. All right. I think that, we're in a good place right now. The only real risk regarding Tesla, in my opinion, is Shanghai opening. We need Shanghai to open back up. I still think we're okay for right now. I think right now, if you account for Berlin and Austin and, how much more Shanghai could possibly do once it opens back up, we might be fine for Q2, but the sooner we can open up, the better. All right, especially since I don't have a lot of confidence in Austin for this quarter. I think Austin is going to be a much slower ramp. Berlin has its own potential issues, but again, everything always has potential issues, so I'm not going to freak out about it. I'm just going to look at what's possible out there. I'm going to look at the risk, and I'm going to think about how these risks could be mitigated and how it potentially the fear of what could be happening may be a little overblown, much as happened today with the CPI report. Okay, so this is a good sign. Looks like things are starting to slow down with inflation. Hopefully this continues. Hopefully we start to see things slow down. Hopefully the the China zero COVID policy, hopefully either that happens faster than expected. Omicron swept through the US pretty fast, swept through Europe pretty fast. Hopefully same happens in China. All right, we're gonna leave it there. Do me a favor, if you guys enjoy this type of content, hit the like button, hit the subscribe button, ring that bell. If you want to support the channel, feel free to sign up for our Patreon. You can find the link down below in the description. Also, if you want to follow us on Twitter, you can find it there as well. All right, enjoy the rest of your guys' day. Hopefully we have a good day in the stock market. I love you all. Peace.